So what's your base case? So as the trade war heats up, UN devaluation and the extra tariffs?
Well, we've been fairly calm about next year's demand, but we've always been low. And what we've seen is the global forecasting agencies have just been coming down and down and down and down. And now we're starting to stare at, will we go under 1 million barrels a day of demand growth next year, whereas many of them had started as high as 1.7 million barrels a day of demand growth. You've got to keep in mind here that the US is over 1 million barrels a day of supply growth alone, well over. So the fact is that the balances have been getting concerning for 2020. I think the other big issue that we always follow that I don't hear often mentioned by oil analysts is the dollar. And it's a very simple reverse correlation between the two, because essentially 90% of world oil trade is in dollars. And therefore, if you get a strong dollar, you're going to see lower oil prices.
So, and we have seen that, talk about the revisions, the major agencies from where they were, say, in January to now. I mean, it's a huge revision for demand growth. How do you factor in things like Iranian tanker seizures, for example, that no one seemed to blink an eye at, for example?
Well, that's a different subject, although it's related to relatively imbalanced oil markets, because you have a lot of spare capacity. So you've got 2 million barrels a day of spare capacity in Saudi alone. You can debate whether the US is spare capacity because it's a different type of short cycle oil, but essentially the market doesn't perceive there to be risk in oil right now, quite simply. And as a result, you're not seeing any impact from the Iranian attacks on tankers, which in a different era, let's say in the 2000s, would have had absolute crazed panic in oil markets because we had no spare capacity.
As a practical matter, does this make the sanctions from the U.S. point of view all the more powerful and effective? Because as a practical matter, Iran, there's not as much demand to try to get the oil around the sanctions, and other people, including the United States, can get the oil elsewhere.
Well, there's a lot of reports out there that China's been circumventing.
Yes.
There's a lot of controversy essentially about how much Iranian oil is actually coming out. And they may well be using the uncertainty around the trade war to take the opportunity to take Iranian oil and circumvent them. So I think the two issues are somewhat separate, to be honest with you.
So obviously the elephant in the room then is U.S. shale supply, sort of playing that market balance way, some might say. How do you look at, say, what we learned from big oil, like a Chevron and Exxon, their development in the Permian, versus independence last week, where I feel like Shale-mageddon was the takeaway from the earnings? Yeah,
and we have the Shale-ennials. Have you heard about the Shale-ennials, the Rice brothers at EQT?
They made it up themselves, though, so it makes it way more lame when you do that for yourself.
Okay, Shale-mageddon. Well, what's extraordinary about the cycle in oil is we now have a situation where Exxon and Chevron, especially Exxon, are growing in the Permian with, regardless of price, absolutely in opposition. Well, essentially, Exxon is outspending, including its dividend, in order to grow in the Permian, absolutely enormous numbers. So what we're highlighting, in fact, in our note this morning is that the combination that reported on Friday, which was Exxon, Chevron, and EOG, particularly we saw Exxon increase its debt in the first half of 2019 by about the amount of its dividend. So essentially it's debt finance growth, and deliver very, very strong 20% in the case of both Exxon and Chevron, more or less 20% in the case of EOG, US oil supply growth. But these are off high bases. So those three companies alone are adding 350,000 barrels a day of supply. Now, what we're saying is important is none of that is particularly price elastic. So if oil goes down to 40, those guys are just going to steamroller the rest of the Permian guys, who don't have the balance sheet. So it's an interesting cycle, because back when Exxon couldn't grow in the US, didn't grow in the US, and was very capital disciplined with very high free cash flow. This is 15 years ago. Today we have the exact opposite, and they're actually enforcing capital discipline on, for example, another controversial name from last week, which was Concho Resources.